Now, the fair value hedge is the first kind of hedge that calls for special treatment by the FASB. The other type of hedge that calls for special treatment, actually there's three. The second kind, the third kind is hedge of an investment in a foreign subsidiary that we're barely going to talk about today. The second kind is what's called a cash flow hedge. And again, this needs to meet the criteria that we spoke about before. If it meets the criteria and your purpose is to designate the hedge for exposure to future changes in anticipated cash flows. In other words, a cash flow hedge is designed to hedge future cash flows. So if something causes a future cash flow to go up, then your hedge is going to have a reduced cash flow. If it's going to cause that cash flow to go down, then this is going to have an increased cash flow and it'll offset each other. And they could go in opposite directions, kind of thing. So this cash flow could be related to a recognized asset or liability, like interest payments is a good example. If you have interest payments with a variable interest rate, then the purpose of the cash flow hedge could be to convert that variable interest rate into a fixed interest rate, or a fixed interest rate into a variable interest rate. It could also be a forecasted purchase or sale. And what you're going to do here is you're going to take changes in fair market value and separate them into effective portion versus ineffective portion. And the ineffective portion is going to be set aside, and the net gain or loss on the effective portion is going to go to comprehensive income, other comprehensive income. The ineffective portion of the hedge, because sometimes cash flow hedges don't cover the whole thing, so the ineffective portion of the cash flow hedge actually goes right to income. So this kind of gives you an idea. You have a change in an anticipated cash flow, and the purpose of the hedge here is to offset that. So if you have an increase in the cash flow, the derivative would decrease, a decrease in the cash flow, then the derivative would increase. When it says here fair value, means the fair value of the cash flow, not the fair value of an asset or a liability. So if you have an increase in cash flow, the actual cash flow increases. You're going to have an offset from the derivative that will make that into a fixed cash flow that doesn't change. And that's what your goal here is. And the extent of the change in the cash flow, the extent to which one offsets the other is going to go to other comprehensive income. And you really can't explain this without actually going through an example. So we're going to talk about these in the context of foreign currency transactions, because you can have fair value hedges and cash flow hedges in foreign transactions. And the third kind of hedge is what's called a hedge of a net investment in a foreign operation. That's a fairly simple one to talk about. It's a lot easier to deal with than a fair value hedge or a cash flow hedge. And let me just go through the importance of what we're doing here. Again, if you meet the requirements for a hedge, for hedge accounting, which are shown here, 1, sufficient documentation, 2, that the hedge is highly effective throughout its term, then you can designate the hedge as one of these 3 types of hedges here: fair value hedge, cash flow hedge, or hedge of a net investment in a foreign operation. But if these criteria are not met, then you have what's called an exposed position, where it could actually be a hedge because you have the 2 sides of it, but they're not treated as a hedge by the FASB, and therefore it will not qualify for treatment as one of these 3 things. So again, if you meet the requirements of the FASB, and the requirements are actually very complicated, I'm glossing over them here for the sake of simplicity, but if you ever get into this, then you're going to need to understand it in a lot more detail. But basically, if you meet the requirements for one of these 3, then you can take advantage of the FASB's hedge accounting rules. If not, then you have what's called exposed positions, and exposed positions are very straightforward. Everything is marked to market value. So let's start off by talking about a forward exchange contract. And this is usually contracted through some kind of dealer like a bank. It can be customized to meet the company's needs, or it can be kind of standardized. There's usually no margin deposit because there's a counterparty who's interested in the same transaction on the other side. And it's completed either with net cash settlement or with an actual delivery. Usually it's going to be a net cash settlement. And FASB Section 815 establishes the basic rule that changes in fair value are recognized as mark to market. And we're basically just going to mark the assets and liabilities to market value, whether it's the hedge, and then the gain or loss, the treatment for that is going to depend on what kind of hedge accounting you're using. The book presents you with 4 different cases. Let's look at case number 1 first, and we'll go through them. Case 1 is where you receive goods or services from a transaction, and then you enter into an undesignated foreign currency forward transaction. In other words, this is what's called an exposed position. Even though it's not exposed, because you have the other side of the transaction here, this really is a hedge, but you haven't met the FASB's requirement, and therefore you're going to need to do just mark-to-market accounting throughout. Everything hits the income statement. Case 2 is going to be a fair value hedge, where you sign a binding agreement for a transaction, and then you enter into the designated foreign currency forward contract to hedge that transaction, the fair value of it. So this is going to be a fair value hedge. Case 3, which I'm going to go through a little faster because what I find is that cash flow hedges, you can't really do justice to them in what we're doing here in the amount of time that we have. But this would be a forecasted expected future transaction, and you enter into a designated foreign currency forward contract like as before. And it'll be a cash flow hedge, and I'll show you how. I'll take you through the journal entries for that. And then we're going to go through settlement of a foreign currency denominated payable or receivable, and this would be a simple speculation transaction. So let's look at case 1. This is the exposed position template, and again, it's not because it's really an exposed position. It may have been constructed as a hedge, and it may actually be effective, but because you haven't met the FASB requirements, it's not treated as a cash flow hedge or a fair value hedge. So let's say Peerless, there we go again, purchases goods on account from Tokyo Industries for 2 million yen, and it offsets the exposed foreign currency liability with a forward exchange contract for 2 million yen. In other words, what it's going to do is it's going to acquire 2 million yen in the future. And here are the terms. The terms are that the forward exchange rate was 0.0075 at the time of the contract. The term equals the credit period. In other words, the term goes up to April 1st, 2022. You have a December 31st year end, and then April 1st, 2022 is the date the payable is going to be settled. So the spot rate on the date that they entered into this forward exchange contract, the spot rate was 0.0070. The forward exchange rate was 0.0075. December 31st, the spot rate was 0.0080, and the forward exchange rate was 0.0077. And then on the settlement date of April 1st, the spot rate was 0.0076. So to enter into this transaction, first of all, remember they're buying a product, they're buying inventory. So they would debit inventory for whatever the value is. In this case, it's going to be 2 million times 0.0070. And the credit is going to be just like it was before, credit accounts payable, Japanese yen, for 14,000. And then we're also going to record the acquisition or the entry into this forward exchange contract. So the value of the forward exchange contract is going to be valued at the forward exchange rate. And the journal entry would be to debit foreign currency receivable from broker with a notation that it's Japanese yen, and it's going to be valued at 2 million yen times the forward exchange rate of 0075. And the credit would be the dollars payable to broker, $15,000, because ultimately we're going to need to pay $15,000. On December 31st, let's first talk about the payable. Let's first talk about the foreign currency receivable from broker. The foreign currency receivable from broker, the forward exchange rate has increased to 0077. So that means right now the foreign currency receivable from broker is valued at $15,000, but the new exchange rate is 0077, meaning that this foreign currency receivable from broker is now worth $15,400. So the journal entry to record this, we're going to need to write up the asset, foreign currency receivable from broker, that's this asset here, because it's denominated in Japanese yen, for $400. So debit foreign currency receivable from broker for, wait, I should have written the amount of the gain. So we write up this asset by $400 and we credit foreign currency transaction gain. It's going to go straight to the income statement. And notice that because it's going to be a little different when we do a fair value hedge. And the dollars payable to broker doesn't change because we're going to have to pay the broker $15,000. That's the deal. The thing is, though, that we're going to get $15,400 worth of yen. That's what we expect to get. And that's why we get to record a gain. The other thing that's going to happen, as it happened before, is this accounts payable needs to be adjusted in value. Right now, the accounts payable, that's going to be based on the spot rate. The accounts payable was worth $14,000, and now the accounts payable is going to be worth 0080. The spot rate. And again, the difference here is spot rate is whatever the value of the yen is at the time. Forward exchange rate would be the value of a forward exchange contract on the settlement date, April 1st. That's the difference between these two rates of spot rate and forward exchange rate. So here, the value of this payable is increased dramatically by $2,000, and that's going to be a loss. So I'm going to increase accounts payable, Japanese yen, by $2,000. And I'm going to debit foreign currency transaction loss. And it's as I said before, these gains and losses really do offset each other on the income statement, but we keep track of them in separate accounts. All right, that's December 31st. Next, I have the wrong date here. It says December 31st, and it should say April 1st, 2022. So first thing that we do on the settlement date is we adjust everything to market value. And again, the book sometimes says you should do this as one entry. I like to do it in as many little entries as possible, and I think that's how they do it in the real world. The foreign currency receivable from broker, there's no point in looking at forward exchange values anymore because today is the settlement date. So it's really just the spot rate. Everything's going to go to the spot rate. Currently, this is on our books at 75 or 15,000. I'm sorry, it's on the books we adjusted it to 77. And the spot rate today is 76, meaning that the foreign currency receivable from broker is really worth $15,200, and therefore I have a $200 loss. So let's adjust the book value. I'm going to credit the asset to reduce it, credit foreign currency receivable from broker for $200. Let me write in here. Japanese yen. And I'm going to debit foreign currency transaction loss for 200. And I'm going to adjust my accounts payable also. So previously my accounts payable was on the books for 80. And now it's worth 76. That's the spot rate. Everything's at the spot rate now because everything is settling. 15,200. And therefore I'm going to have a gain because this is a liability going down. So I'm going to debit accounts payable. I do find that it helps just to say it out loud. You know, again, don't do it on a test. Foreign currency transaction gain, $800. Now everything has been adjusted to market value. And the next thing I'm going to do is I'm going to pay the broker $15,000. That was what I agreed to pay the broker, and this dollars payable to broker hasn't changed. So I'm going to debit dollars payable to broker for the original amount, in this case $15,000, and I'm going to credit cash for $15,000. Next, I'm going to get my foreign currency units. And I'm going to get 2 million yen, which are worth 0076. So I'm going to debit foreign currency units, Japanese yen, $15,200. The credit will be to foreign currency receivable from broker because I'm finally getting that money. And it just happens to be very nice that if you do the math, you'll see that that's how much is in that account. And now I have my foreign currency units. I can pay off the payable. So I'm going to credit foreign currency units, Japanese yen, 15,200. And I'm going to debit accounts payable, Japanese yen. And now the inventory is paid for, finally. And so this should be very straightforward. You basically have two assets here. When you make this acquisition, you have a liability, I'm sorry, I said two assets, accounts payable, Japanese yen, that needs to be adjusted to market value based on the spot rate, and foreign currency receivable from broker that also needs to be adjusted to market value, but it's going to be based on the forward exchange rate. And on the settlement date, it'll be adjusted to the spot rate because there is no more forward exchange rate. The forward exchange date is the spot date, and that's why those are the same.